What's up, good people? It's yours truly, Natasha Varela, also known as the Moneyista. Over 20 years in audit, accounting, and tax, 13 in the large business and international division of the Internal Revenue Service. So I want to talk about tax planning. Tax planning often includes what we call expense acceleration. So I'm going to give you a good example. If you follow me on Instagram, you know that I documented the totaling of my car in an accident. My paid off car. We all love a paid off car. We all, dislike car notes. However, it was an opportunity for me to reduce my tax liability by purchasing a vehicle under my business name. Now, the rules are the vehicle has to be over or 6,000 pounds, right? And gross vehicle weight and under 14,000 pounds. And you can check that on the inside door of your vehicle or do a simple Google search if you're thinking about a vehicle, right? And not only that, it has to be used for over 50% of the time for business. As an examiner, I'm going to tell you 100% of the time for business. It's safe, right? And also, you need to be able to upkeep the vehicle, okay? Now, did I want to purchase this vehicle at this moment in time with no car note? No, but it was an opportunity for expense acceleration. That means I can offset my tax liability by purchasing the vehicle under my business for business use. So I got to take section 179, which means I get to take the whole cost of the vehicle, okay, in relation to the percentage of business use. So if you use the vehicle for 80% of business use, you get to take 80% of the cost of the vehicle in your business. But I try to encourage 100%. And that means having another car available for personal use. Okay. For those of you out there who may have a second vehicle, it's a good way to prevent an audit or problems in an audit when you have another vehicle available for personal use and your business vehicle separate. So you get to take 100% of the vehicle cost upfront in the first year. Now, again, make sure that you can afford the upkeep of the vehicle, but for purposes of tax planning, it's good to do things like expense acceleration where you normally wouldn't purchase something, but you have an opportunity to do so that you can offset your tax liability. Because at the end of the day, I'm either going to pay Uncle Sam in my tax liability, right? Or I'm going to pump the money into business assets like a vehicle. Okay. So that's just something you guys should think about as far as keeping track of your tax liability. I teach that in a tax strategies mastermind. You cannot reduce or eliminate your taxes if you don't know what they are, and you should know what your tax liability is at any point in the year. That is what good tax planning is. So if you want to learn more, go ahead and click the link in the bio. If you're seeing this in an ad, go ahead and click the link or hit the messenger button for details on how to register for my free live training.